it's Jane here, and I've been having some really interesting conversations with people this week around mortgages and lending and finance, and I thought, you know what, I'll take the bull by the horns and record this special video for you. So a lot of people that I've been speaking to have shown relief and excitement about the fact that APRA has finally stepped back and said, hey, good guys, well done banks, you've reduced the investor lending to below that 10% cap, it's all okay now, and that cap is no longer in place. So there's been a lot of relief and a lot of assumptions that the banks are going to now take back a few of those requirements and those extra stipulations they put in place that made it a bit harder for investors to get lending. And to some extent we might see a little bit of that, but I don't really believe that we are going to see a complete rollback. Now, if you looked at the paper today, so here's the Financial Review, I've actually got the head of the RBA saying loans are actually going to get harder to get, and I think there's a couple of reasons for that. Now, everyone is watching the Royal Commission at the moment, and not to name names, but this was in the front page of the Fin Review today that says that APRA had a scathing attack on a particular large lender because of their culture of arrogance and complacency and the fact that they hadn't been looking after their clients well enough. Now, the Royal Commission itself, as we know, is going on. The banks are getting a bit of a bashing regarding that, particularly financial planning. And, you know, I was looking at the numbers that have just come out from the ATO regarding the 2015-2016 super. And it actually shocked me to see that people earning between $80,000 and $180,000, the median balance of their super is $120,000. So, you know, that's what a lot of people actually have as their super balance. And that's just incredible. There's been 20 years that we've been contributing now to super. Financial planners have been assisting us to do that. We make a contribution. Someone out there is actually investing on our behalf. And our assets should be going up in value. So, you know, what I would, I guess, really caution those who think that things are going to get a whole lot easier is that it's not necessarily going to be the case. So there's a couple of reasons for that. Now look, it's been the 19th time in a row that Reserve Bank yesterday left interest rates on hold, and because they don't actually meet in January, it means it's 21 months since they actually moved interest rates. So there's some relief regarding the fact that rates haven't risen. Now, things are actually looking positive. You know, the Reserve Bank of Australia has come out, they've said that, you know, they're expecting, you know, the economy to grow 3% next year. They haven't changed that. They're looking at the fact that, you know, the Sydney and Melbourne market has come off a little, which is good. I think, you know, we're talking less than 1% reduction overall in Australians' house prices in the last year. So we're not talking about the fact that you can rush out and get a bargain. We're talking about a gradual slowdown. But the major thing is that I'm hearing a lot of people saying, look, we can now wait. Now, what I am seeing is that that's not necessarily the case. The banks may, in trying to get a little bit of goodwill, might bring back some of the interest rates that they inflated the investors' interest rates by to because they don't need to try to stop the investors getting loans anymore because of the caps being removed. But I don't think we're going to see it getting easier for us to get loans. So with the Royal Commission, you know, this whole attitude of complacency, I think we're probably going to see the banks getting a bit tighter. And I also think, you know, when you look at the long-term 10-year bond yield rate in the US, we're talking about the cost of funds could go up as well. The US is looking at putting rates up, etc., etc. So I think the cost of money to the banks could increase in the next 6 to 12 months. I think we're not going to see the RBA put up rates, but I don't think we're going to see any lessening either. So, you know, yes, the market might be coming back a little bit, but, you know, when we're talking about the market coming back maybe $5,000, $10,000, $15,000 on some of these properties in capital cities, if you can't get the borrowing capacity that you can get today in 6 months or waiting 9 months, I think you're really in for a bit of a shock. So don't think that this reduction or the relief on the cap that APRA's announced means that it's okay and you don't need to do things. I think lending is actually going to get harder to do, and we're seeing in Investors' Choice Mortgages when we're putting in loan applications now, the checks and balances and the hoops that we have to jump through, and even simple requests of having credit cards reduced by $100 is just extraordinary. So I think that the lenders are going to get tougher. They're going to try to step up their act and be more responsible. I don't think we're going to see any significant policy changes. I'd like to think that the interest rates they increase the investor loans by will come back down. I don't think we're really going to see that. It'd be a nice show of goodwill if they did. But we know that for a long period of time, investors and owner-occupiers had the same interest rates. When things changed early last year, we saw some significant changes. We saw interest-only loans, interest rates go up. We saw investor loans go up. So, if you were an investor and had an interest-only loan, you probably have got a bit of a double whammy. So your interest rates went up even further. The good news is the majority of people ticked the box that said, I want to make a repayment of whatever it was, $2,200 a month. And what has happened is that as interest rates have come down over the years, they're still paying $2,200 a month. So the majority of people are actually well ahead on their repayments. Now, if you're paying interest only, then obviously we want to make sure that all that extra funds go into offset accounts so that you do have a buffer. We do expect interest rates to increase, at least in the first quarter of 2019. If interest rates do increase, even though lenders are using a buffer now of 7.2% up to 8% of when they're assessing how much you can borrow, that's probably going to go up as well. So even though we can get interest rates for 3.8% owner occupiers principal and interest, investor rates around 4.8 interest only for investors, and and a bit less in some instances. But I think that the fact of the matter is, the people who think that they can wait and maybe not move, I really consider that you really take action and think about this. And those of you who are having an interest-only loan coming up for renewal, and it might go to principal and interest, we know your servicing capacity has reduced over the last few years. It'd be really great to check that out now and lock in an extra interest-only term if that's what your portfolio plan and what you're basing your whole portfolio growth and holding that portfolio is based upon. Because the worst thing can happen, your loan goes to principal and interest, it's costing you an extra $3,000, $4,000, $5,000, $7,000, $10,000 a year. You can't hold that property, but you're in the middle of the cycle where it's not as a great time to sell, and you're forced to sell. So we want to give you all the options. I want to make sure that you have the buffers in place, you understand exactly what's going on. It has concerned me that a number of people have decided that it's time to wait because APRA has lifted that 10% cap on the lenders for investment lending. I don't think we're going to see things get easier. Front page of the paper says things are not going to get easier. So I really encourage you to have a look at your lending. Contact us, obviously investorschoice.com.au, go to the contact page, make a time to have a chat, because we really want to know what we can do to assist you so that you are ready for the changes ahead. Anyhow, it's great talking to you. I hope you have a really good day.